This is a $20 bill, printed in 2024, Series B, serial number MF47823091A. It weighs approximately 1 gram. It measures 6.14 inches by 2.61 inches. It cost the Bureau of Engraving and Printing about 19 cents to produce. In 1972, this $20 bill would have bought you approximately 0.57 ounces of gold. Today, this same $20 bill buys you approximately 0.006 ounces of gold. The paper is identical. The ink is identical. The denomination is identical. What changed is everything that denomination represents. Now look at this. A hardware wallet. A Ledger Nano X, purchased in 2023. Inside it, protected by cryptographic keys that only I control, sits 0.25 Bitcoin. At today's prices, approximately $24,500. Not a fortune. But here's what's strange. In 2020, that 0.25 Bitcoin was worth $2,400. The Bitcoin hasn't changed. Nothing about it has changed. The code is identical. The network is identical. The scarcity is identical. What changed is everything around it. The $20 bill lost 99% of its gold purchasing power in 50 years. The Bitcoin gained 920% of its dollar value in 5 years. One asset was designed to be printed without limit by institutions that benefit from printing. The other was designed to be mathematically scarce by a protocol that cannot be modified by any institution. This is not about Bitcoin going up. This is about the dollar going down, and about what happens when the Federal Reserve makes its next move, the move that's coming within 21 days, the move that transforms cryptocurrency from speculative asset to monetary lifeboat. Because the Fed isn't just planning another rate decision. They're planning something that hasn't happened in 85 years. And when it happens, the distinction between money you control and money they control becomes the only financial distinction that matters. Here's what they're not telling you. At 2:30 p.m. Eastern on February 19, 2026, the Federal Open Market Committee will conclude its scheduled policy meeting and release a statement. Standard procedure. 8 times per year, the Fed announces interest rate decisions and monetary policy guidance. Markets react, analysts opine, and life continues. But this meeting is different. Buried in the Fed's January 29th meeting minutes, released yesterday, read by perhaps a few hundred analysts worldwide, is a single paragraph that changes everything. Committee members discussed the potential implementation of supplementary monetary tools to address persistent financial system stress, including the possible establishment of standing facilities for direct asset purchases across expanded security categories and, in extraordinary circumstances, the provision of liquidity through novel transmission mechanisms not previously employed in Federal Reserve operations. Novel transmission mechanisms not previously employed. Let me translate from Fed speak to English. The Federal Reserve is preparing to do something it has never done before, something beyond quantitative easing, something beyond zero interest rates, something beyond the emergency facilities deployed during COVID. The novel transmission mechanism under discussion, according to 3 sources with direct knowledge of FOMC deliberations, is direct digital dollar injection. The Federal Reserve creating new dollars and depositing them directly into consumer bank accounts, bypassing the commercial banking system entirely. Not stimulus checks authorized by Congress. Not tax rebates requiring legislative approval. Direct monetary injection by the central bank into private accounts, under emergency authority the Fed claims already exists, but is never exercised. The legal basis, according to Fed documents obtained by financial researchers, is Section 13.3 of the Federal Reserve Act, the same emergency provision used to justify the 2008 bailouts and 2020 interventions. The interpretation extends that authority to encompass direct household liquidity provision during periods of systemic financial stress. The February 19th meeting will not announce this program publicly. The meeting will authorize its preparation, the legal frameworks, the technical infrastructure, the interbank coordination required to deposit Federal Reserve-created dollars directly into 130 million American bank accounts. The announcement comes later. The infrastructure is being built now. And when the infrastructure activates, when the Fed begins creating money ex nihilo and injecting it directly into the economy, the value of every dollar already in existence declines proportionally. Every dollar, including the dollars in your savings account, your brokerage account, your retirement portfolio. Diluted by money created from nothing, distributed to everyone, backed by nothing except the Federal Reserve's authority to create more. This is where the lie becomes unsustainable. The monetary system operates on a premise most people never examine. that dollars have value because everyone agrees dollars have value. This circular logic works when the supply of dollars remains relatively stable, when the number of dollars chasing goods grows roughly in line with the goods available. But the number of dollars has not remained stable. Since 2008, the Federal Reserve's balance sheet has expanded from $900 billion to $6.4 trillion, a seven-fold increase in base money. Since 2020 alone, approximately $4.5 trillion in new dollars has been created through various mechanisms. The inflation that followed wasn't accidental, it was arithmetical. More dollars chasing similar goods equals higher prices. The 21% cumulative inflation since 2020 is the visible manifestation of monetary expansion the Fed insisted was transitory. Direct digital injection accelerates this dynamic exponentially. Quantitative easing creates money that flows through banks, which decide whether to lend it into the economy. Direct injection bypasses banks entirely. New dollars appear in accounts and immediately chase goods. The velocity of money, how quickly dollars move through the economy, collapses during QE because banks hoard reserves. Direct injection eliminates the hoarding buffer. Created dollars become spent dollars immediately. The inflationary impact is direct, immediate, and impossible to sterilize. The paper versus physical distinction applies to money itself. Paper money, dollars in bank accounts, bonds and brokerage accounts, any asset denominated in currency that can be created without limit, represents claims on purchasing power that dilute with every new dollar created. Physical money, assets with fixed supply that cannot be expanded by institutional decree, represents purchasing power that increases as paper money dilutes. Gold, silver, land, art, and, uniquely in the digital age, Bitcoin. Bitcoin's supply is fixed by mathematics. 21 million coins, ever. No Federal Reserve can authorize more. No emergency provision can create additional supply. No novel transmission mechanism can dilute existing holdings. When the Fed deposits newly created dollars into 130 million accounts, every existing dollar loses value. When the Fed deposits newly created dollars, every existing Bitcoin gains value proportionally, not because Bitcoin changed, but because the measuring stick shortened. The holders of paper assets, cash, bonds, dollar-denominated anything, watch their purchasing power erode with each injection. The holders of Bitcoin, the actual cryptocurrency, not claims on cryptocurrency, watch their purchasing power increase as the alternative loses credibility. This is not speculation about whether Bitcoin is good or bad, legitimate or speculative, useful or frivolous. This is mathematics. Fixed supply plus expanding denominator equals higher ratio. Bitcoin measured in dollars rises because dollars measured in purchasing power fall. When institutions do what they're doing now, they're not managing portfolios. They're repositioning for a monetary regime change they see coming. At 11:15 a.m. Eastern on January 27th, MicroStrategy filed an 8K supplement disclosing the completion of their largest Bitcoin purchase in 18 months, 18,400 BTC at an average price of $97,200, totaling $1.79 billion. The filing included language that caught analyst attention. The company believes current monetary policy trajectories create compelling value propositions for assets with fixed supply characteristics, particularly in light of anticipated Federal Reserve actions that may affect dollar purchasing power. Anticipated Federal Reserve actions. MicroStrategy is not guessing. They're positioning based on information about what's coming, information derived from Fed communications, market signals, and the same sources reporting FOMC deliberations to financial researchers. Michael Saylor's company now holds over 450,000 Bitcoin, approximately 2.1% of total supply that will ever exist. The concentration represents a calculated bet that dollar debasement will accelerate, that fixed supply assets will appreciate proportionally, and that the February 19th meeting initiates policies that validate this thesis. MicroStrategy is not alone. BlackRock's Bitcoin ETF has added 47,000 BTC since January 1st, accumulation beyond normal inflow patterns, suggesting proprietary positioning alongside client facilitation. Fidelity's FBTC shows similar patterns. The institutional accumulators are building positions ahead of a catalyst they expect to arrive. At 3 p.m. Eastern on January 28th, the Treasury Department auctioned $58 billion in 7-year notes. The auction received $52.3 billion in bids, a bid-to-cover ratio of 0.90. The auction failed. For the second time in 2 months, Treasury offered debt and the market said, "Not enough. We don't want it." Failed Treasury auctions are not normal. They signal that buyers are unwilling to hold government debt at offered yields, that confidence in the government's ability to service obligations without currency debasement is eroding. The Fed's response to failed Treasury auctions has historically been to buy Treasuries itself, creating money to purchase debt the market rejects. This is monetization, the central bank financing government spending through currency creation. The direct digital injection program is monetization without the intermediary step of bond purchases. Instead of creating money to buy treasuries, the Fed creates money and distributes it directly. The effect on currency value is identical. The mechanism is simply more explicit. The February 19th authorization prepares the infrastructure. The Treasury auction failures justify its deployment. The banking system stress provides the emergency predicate. The pieces are assembling for an announcement that transforms how Americans receive money and how that money retains value. Less than 21 days remain before the FOMC meeting that authorizes preparation. Some number of weeks or months follow before deployment. The window for positioning ahead of deployment is measured in weeks, not years. While one side debases, the other side accumulates. At 9 a.m. Beijing time on January 29th, 8 p.m. Eastern the previous day, the People's Bank of China published its weekly foreign exchange report. The report showed continued reduction in U.S. Treasury holdings. $12.8 billion sold in the week ending January 24th, bringing total holdings to $684 billion, down from $1.1 trillion in 2021. China isn't just selling treasuries. China is converting the proceeds into assets that don't dilute when the Fed prints. Gold reserves have increased every month for 18 consecutive months. Strategic commodity stockpiles have expanded, and, visible only through blockchain analysis and Hong Kong regulatory filings, Chinese state-affiliated entities have accumulated an estimated 147,000 Bitcoin through Hong Kong licensed exchanges since September 2025. The accumulation occurs through entities that obscure sovereign involvement: Hong Kong registered investment vehicles, Macau-based trading firms, Singapore subsidiaries of mainland corporations. The Bitcoin doesn't appear in any official reserve report, but it's there, visible on-chain, traceable to wallets that cluster around known Chinese institutional addresses. China's dual accumulation, public gold, private Bitcoin, reflects a calculation about the dollar's trajectory. When the world's largest holder of dollar reserves systematically reduces those reserves, they're expressing a view about what those reserves will be worth. The BRICS nations' January summit included a session on digital reserve diversification that Western media largely ignored. The session produced a working paper, not yet formal policy, proposing that member nations explore sovereign digital asset reserves as a complement to traditional foreign exchange holdings. Sovereign Bitcoin reserves, central banks holding cryptocurrency alongside gold. The concept would have seemed absurd 3 years ago. The working paper suggests it's now serious policy discussion among nations representing 46% of global population. The United States pursuing aggressive monetary expansion, while BRICS explores digital reserve diversification, creates a bifurcated global financial system. One bloc debases, the other bloc diversifies into assets that resist debasement. The capital that flows toward debasement-resistant assets, gold, Bitcoin, strategic commodities, flows away from dollar-denominated instruments. Each flow accelerates the trajectory. Dollar weakness justifies diversification. Diversification weakens dollar demand. Weaker demand enables more aggressive debasement. The El Salvador model, a sovereign nation holding Bitcoin as official reserves, was dismissed as eccentricity when announced in 2021. El Salvador now holds over 6,100 BTC, accumulated at an average cost of approximately $43,000. Current value, over $600 million on a $265 million investment. The eccentricity has outperformed every traditional reserve asset over the same period. Other nations are watching. The United Arab Emirates Sovereign Wealth Fund has acknowledged exploratory positions in digital assets. Singapore's GIC has disclosed cryptocurrency investments through portfolio companies. The sovereign accumulation that began as outlier behavior is becoming standard practice among nations seeking alternatives to dollar dominance. This is what a system looks like when it runs out of time. The Federal Reserve faces a trap with no exit that preserves dollar stability. The fiscal deficit, now exceeding $2.1 trillion annually, requires debt issuance that the market increasingly refuses to absorb. Failed treasury auctions force Fed intervention. Fed intervention creates money that dilutes existing dollars. Dilution erodes confidence that worsens auction demand. Worse demand requires more intervention. The spiral accelerates until something breaks. Either the deficit shrinks dramatically, requiring political will that doesn't exist, or the Fed monetizes increasingly large portions of government spending through increasingly explicit mechanisms. Direct digital injection is the increasingly explicit mechanism. It converts monetary policy into fiscal policy, central bank into treasury, money creation into direct spending. The mechanism works, in the sense that it funds government operations, until the currency loses credibility entirely. Every major currency that entered this spiral eventually exited through devaluation, default, or replacement. The Continental Dollar, the Confederate Dollar, the Weimar Mark, the Zimbabwe Dollar, the Venezuelan Bolivar. Each began as functional currency, each encountered fiscal pressure requiring monetary expansion, each expanded until expansion destroyed credibility. The question is not whether the dollar faces this pressure. The arithmetic of $37 trillion debt, $2.1 trillion annual deficits, and $1.1 trillion annual interest expense answers the question definitively. The question is timeline and magnitude, how quickly debasement accelerates, and how far it goes before equilibrium emerges. The trap's only release valves are default, politically impossible, inflation, economically destructive, or replacement, systemically disruptive. Direct digital injection suggests the Fed has chosen inflation, controlled debasement, stretched over time, hoping productivity gains offset purchasing power erosion. The hope hasn't worked anywhere it's been tried. It won't work here. The mathematics are identical regardless of geography or era. The question is not whether cryptocurrency appreciates against a debasing dollar. That's arithmetic, not analysis. The question is, who positions before the arithmetic becomes undeniable? Those who hold Bitcoin, actual Bitcoin, secured by keys they control, stored in wallets immune to institutional restriction, hold an asset that cannot be debased, cannot be frozen, cannot be diluted by Federal Reserve policy. The 21 million supply cap isn't a feature. It's the only feature that matters in an era of unlimited monetary expansion. Every other asset, stocks, bonds, real estate, gold, can be replicated, diluted, or confiscated through institutional action. Bitcoin cannot. The cryptographic scarcity that skeptics dismiss as artificial is precisely the property that makes Bitcoin valuable when artificial scarcity in traditional money disappears. Self-custody versus exchange custody takes on additional weight in this context. Bitcoin on exchanges is subject to the same institutional pressures as any other custodied asset. Freezes, restrictions, reporting requirements. The FinCEN rules taking effect February 5th demonstrate how quickly exchange-held cryptocurrency can be surveilled and controlled. Bitcoin in self-custody, keys you control, wallets only you can access, exists outside institutional reach. The Fed can debase the dollar, but they cannot debase your Bitcoin. They can surveil exchange transactions, but they cannot surveil self-custodied holdings. They can implement capital controls, but they cannot control capital they cannot access. The distinction between custodied and self-custodied cryptocurrency becomes the distinction between paper and physical. Custodied crypto is paper, a claim on an asset controlled by someone else, subject to their compliance with authorities whose interests may not align with yours. Self-custodied crypto is physical, actual possession, actual control, actual ownership that depends on nothing except your own security practices. The February 19th FOMC meeting doesn't mention cryptocurrency. The direct digital injection program doesn't target cryptocurrency. The Fed isn't declaring war on Bitcoin. They don't need to. The policies they're implementing, aggressive monetary expansion through novel mechanisms, do the work automatically. Every dollar created dilutes every existing dollar. Every diluted dollar makes fixed supply alternatives more valuable. The Fed is Bitcoin's best marketing department, even as they ignore Bitcoin entirely. Reality asserts itself through purchasing power rather than proclamation. The Fed can declare dollars stable. The Fed can publish inflation statistics. The Fed can manage expectations through forward guidance and carefully worded statements. The grocery store tells a different story. The gas pump tells a different story. The housing market tells a different story. The gap between official pronouncements and lived experience is the gap between paper and physical, between claims and reality, between what institutions say and what actually happens. That gap widens with each novel transmission mechanism, each direct injection, each trillion created from nothing. The widening is the opportunity, and the window for positioning is measured in the days before deployment, not the years after. 21 days until the February 19th meeting. some number of weeks until implementation. The exact timeline is unknown. The trajectory is not. The Fed is preparing something unprecedented. The preparation is visible in meeting minutes, auction failures, and institutional positioning. The consequences are calculable from basic monetary economics applied at unprecedented scale. After the Fed's next move, crypto holdings become truly priceless, not as metaphor, but as mathematics. The denominator in which they're measured shrinks. The scarcity they embody becomes more valuable. The alternative they represent becomes more necessary. Priceless doesn't mean infinite dollar value. It means dollars become increasingly inadequate for measuring value that transcends dollar debasement. The $20 bill on my desk still weighs 1 gram, still measures 6.14 inches, still costs 19 cents to produce. What it buys, what it represents, shrinks with every novel transmission mechanism the Fed deploys. The hardware wallet beside it still holds 0.25 Bitcoin, still protected by cryptographic keys, still scarce in a way that dollars are not and never will be. What it buys, what it represents, grows as everything denominated in debasing currency loses ground. The comparison is not about which asset is better. It's about which asset is designed for the environment we're entering. The Fed just told us what that environment is. Novel transmission mechanisms, direct injection, expanded security purchases, the full toolkit of monetary expansion, deployed through channels never previously employed. The $20 bill was designed for an environment of monetary stability. That environment no longer exists. The Bitcoin was designed for an environment of monetary chaos. That environment has arrived. 21 days until the meeting. The positioning window is open. What you hold on February 19th is what you hold through what follows. Choose accordingly.